moving on in the agenda, I'm going to introduce our next session, which is going to be a panel called Approaches and Models for Institutional Investors. In this case, we are going to count on two great panelists. The first one is Iker Barron. Iker is the CEO of Portocolom, a pioneer Spanish wealth advisory firm. And also we are counting on Hailey, which is the head of impact at responsAbility, a global asset manager specialized in ESG and impact investment. Wow. In this session, they are going to tell us their experience while working with institutional investors. So, to start, I would like to ask Paul and Iker to introduce themselves and tell us a little bit more about your organizations. I don't know, maybe Paul want to go first?
Sure. Well, thank you very much to everyone for having me today and for joining us today. It's a real pleasure to be here. My name is Paul Hailey. I'm the head of impact at responsAbility Investments. And for those of you who don't know responsAbility, we are an asset manager based in Switzerland, in Zurich, with a presence across the world in Bangkok, Mumbai, Nairobi, Lima. And effectively, all we do is impact investing. So we only do impact investments. We only do private debt and private equity. And we only invest in emerging and frontier markets. And this is what we do. And in terms of, well, the three areas where we invest are financial inclusion. So we finance or invest in financial institutions, microfinance institutions, SME banks, etc. We also invest in sustainable agriculture organizations, so fair trade cooperatives, processors, etc. And we invest in climate finance, which can be a mixture of lending to financial institutions so they can make green loans. It can be investing in companies that provide off-grid energy solutions, or it can be helping to do project finance for on-grid mid-size hydro plants or solar plants. So it's a real mixture, and we have about $3.5 billion under management, and we invest in about 70 different countries. As I said, all in emerging and frontier markets. Now, around 85% of what we do is private debt, and 15% is private equity. And in terms of specifically with regard to institutional investors, well, first of all, from a structural perspective, to be a little bit prosaic, some of our products, we have only one product that's open to retail investors, but retail investors still nonetheless account for about a third of our investors. Institutional investors account for, I'd say, about another third, roughly, of our investor base, with the remaining third taken up by the development agencies, the DFIs, so-called. And so those institutional investors are invested in the vast majority of our products in one respect or another. Now, some of those products have a longer track record, they're private debt only, and they only have private investors. And that is principally within the area of financial institutions, for example. Other products are perhaps a mixture of private debt and private equity, or a private equity only. And they're primarily focused, and then again, we also have other products which are what we call blended, which is to say it's a mixture of institutional investors and also these development agencies. Often you'll find that the development agencies in those cases are accounting for a higher risk profile. Effectively, they're trying to catalyze investments by institutional investors. So those kind of products in particular allow private institutional investors to invest in spaces where otherwise, frankly speaking, the risk return profile wouldn't kind of really work for them as much. So that's from a structural perspective what it provides. What else does it provide beyond that for institutional investors? Well, I would say that there's a couple of things that I think are particularly noteworthy, and then I'll leave the stage for Iker to pronounce maybe a little bit in more detail on that. One is that, as mentioned before, this is effectively allowing a lot of investors, institutional investors, to access markets which otherwise they typically just wouldn't be able to access. So to go into markets that are well beyond the BRICS, the mints, or whatever acronym is du jour of the moment. Other thing is that typically it often allows them to access products and markets which, frankly speaking, have very little correlation with capital markets. Again, if you're investing in a series of microfinance institutions in the likes of Kyrgyzstan or in India or in Kenya, these are wildly diversified markets, and the average end client of those institutions has very little correlation. Their fates have very little correlation with what's happening with the Dow or the FTSE. But I'd say most of all, and I speak selfishly because I'm the person in my organization who focuses on impact and ESG, I think most of all, from my perspective, what these products offer institutional investors is the opportunity to invest in an area where impact really truly is meaningful, to actually have a contribution, to have what is known, and I'm still not sure if this is a made-up word or not, this famous additionality. Because unlike with capital markets, where you're investing in a secondary market, here you are directly financing or directly investing in institutions that are themselves fundamentally impactful. You are focusing on an impact case. To pick one example, if we are financing, some of our investors are financing a microfinance institution, you are directly financing the expansion of their loan portfolio. You are directly allowing them to reach out to more low-income households and small businesses that otherwise are typically excluded from access to finance. And in doing so, you are, of course, directly contributing to the SDGs, the Sustainable Development Goals, in the countries where this matters the most. And I hope I haven't taken too long to explain. At this point, I'd hand over to Iker.
Okay. Thank you, Paul. Maybe it's your turn, Iker.
That was quite an introduction. I can see the passion, and I like that. First of all, thank you, Social Nest. Thank you, Margarita. Thank you, Monica, for letting me be here with you today, also with Paul. It's a pleasure to be here. Okay, Portocolom is the company that I founded in 2008 with the purpose of helping institutional, corporate, institutional, and private clients to achieve their financial goals. In 2018, we made a strategic review of our business, answering an historic request of our clients, where my money goes and what good it does. Prior to that time, we thought that we didn't have enough information on that field from the companies so we can answer that question. But after that, we think we were ready. So we set a very clear target. By 2021, the total amount of our clients' assets will be invested with a sustainability approach, and we will track how our investments have an influence in each of the sustainable development goals. Out of these assets, between 5 to 10% of them, that they will be invested in impact investment, specifically the illiquid asset that Paul has been talking before. As of today, we have institutional clients such as mutual funds, pension plans, insurance business, other advisory entities, foundation, and faith-based investors, among others. We cover a very wide range of services, both in the liquid and illiquid assets, and our vision is to become a referent in the advisory and management of the Invest for Impact and Invest with Impact universe. To achieve this, we have developed a business model in search of the excellence in our approach to our stakeholders, doing well by doing good, and good practice and content divulgation.
Thank you, Iker. Well, thanks to both for such a good information about yourselves and about your organizations. So, starting with the panel, and given your experience working with institutional investors, I would like to ask you, on one hand, what are the motivations that you have seen on institutional investors when they are when you are approaching to them, and also on the other side, what are their main concerns, and how do you attempt to address those concerns? Will you start? I don't know, Iker, maybe you go.
Okay, perfect. For the first question, the institutional clients' motivation, we are living very interesting times in the asset management industry because we think that we are in the middle of a dramatic change of paradigm. And one of the key drivers of this change is the way investments are considered. And perhaps the biggest one comes from the regulatory field, because in the coming months, like it or not, everybody will have to declare its commitment to sustainability and risks associated on it. So if it's not by vocation, it will be by obligation. This has its pros and its cons. In one side, it is the most effective way to really change the status quo and mobilize money toward the 2030 agenda. On the other side, the risk of greenwashing is huge, and there are many institutions that may want to just surf the wave and keep their good image. That said, we are proud of the clients we work with. All of them share our way of understand the approach to sustainability, and the reasons why we work with them is because they really want to make sure they are contributing to a better way of doing things and to help companies to transition toward a more sustainable model. Answering the first question.
Okay, thank you. Maybe, Paul, you can tell us a little bit about that.
Of course, yes, and I think Iker phrased most of it actually very, very neatly. I would likewise echo the fact that yes, obviously regulatory pressures are part of it, and also I would say in the case of some organizations, for example, some of the insurance companies, I think in general they have a commitment to move in the direction of, for example, action with regard to climate and with regard to environment. It's not too far from their core business model in any case. You know, if any organization should be aware of the impact of climate change, for example, it should be the big insurance and reinsurance companies. Elsewhere, I think there are, as I mentioned before, there are some investors we found, especially when it comes to pension funds, that are motivated to get involved in impact investment, or at least in our corner of impact investment. We are just one corner of it, because of the combination of stability of returns and lack of correlation with capital markets. Now, it isn't complete decoupling of correlation. Of course, fundamentals still play their part, but that is part of the story as well. But beyond that, I agree with Iker. There is a general shift, in terms of society. I mean, we've seen this across all aspects of society. Investing is like any other aspect of life, in that consumer choice is becoming more and more notable. People are realizing their powers as consumers, and it's logical that the organizations realize their powers as investors. And so from a practical perspective, it means that you have pension funds where the contributors to those pension funds are becoming more vocal on this. They want to know where their money is going. They want to know what they're financing. In its most extreme, this is also being, you can also see this with the fact that there are other groups of institutional investors that are popping up, like faith-based investors, for example, who are becoming increasingly vocal within our space. And it is logical that they would want to align their investment strategy with what they're doing. What I think is the change now, perhaps to a certain extent as well in our industry, is that there are now quite a few impact investing products that have a real track record behind them. So if you combine that with the fact that, yes, there are products with a real track record, there are also other products springing up that have a very innovative structure. I mentioned some of these blended structures. And ultimately, I think there's just a lot more choice out there for institutional investors as well in terms of products. So I think that also is creating its own momentum in terms of what they're looking for.
Great.
Yeah, you say it's not only it's history of faith, now it's history of data and measures. So that's a great point.
Yeah, very interesting. So according to that, what kind, maybe Paul already mentioned something, but maybe you can tell us a little bit more about the kind of products or services that you offer for institutional investors according to their appetites and according to their risk profiles. Maybe you can tell us a little bit more about that. Maybe, I don't know, Paul, if you want to go first, or...
Yeah, sure. Because we don't have products, so...
Okay.
Yeah, or services, I don't know. Mm-hmm.
I mean, I should preface this by saying, of course, I work on, as I mentioned, on the impact measurement side. So, but if I look at the types of products we're offering now, there is still quite a range out there. And as I mentioned before, you're looking at even institutional investors, of course, as I'm sure everyone on this call knows, it's such a wide range of possibilities, and that's no different for impact investing. You have, for example, the foundations where I think they're very motivated often by the subject of impact. There's a very detailed due diligence of the whole impact mechanism. As I said, those expectations in terms of can differ from, say, from the pension funds. So from our perspective, we have products, for example, which are, say, private debt only, where the range of returns, the returns are generally very stable, and it's something that's is stabilized over a long time. Focus, for example, on the financial inclusion space. And there, For example, this is something where either institutional investors get involved with their own products, or as we have in one case, we have one product where a pension fund has given us a mandate, and it's I believe for around $300 million, and it's one investor only, a product that is focused on the microfinance side. Then there are other products, as I've said, that are blended, that involve a mixture of public and private money. Perhaps, for example, in the space of climate finance, the mixture of either lending to banks, which themselves are then making green loans to small businesses in the developing world for energy efficiency loans or for solar-powered irrigation systems, or directly to organizations that are providing renewable energy solutions. The products that we have in that space are typically, as I said, we are often using public investors who are willing to take a disproportionately large share of the risk in order to catalyze private investment. In all cases, again, focused overwhelmingly on the developing world, and very much focused and very clearly impactful, I would say, as a result. I think that's where I would stop, and then Iker, maybe if you can comment on how you also help your clients with this.
As I told you, we don't have products, but with our clients we have all the different providers. So you know better than me. I want to come back to the question about the biggest concerns, because as we just asked before, I want to mention three bigger concerns that we have found with our clients in the 3 years that we have been working with impact investment. The first of all of us know, it's greenwashing. Greenwashing is like everybody is like, this is the new mode, and everybody goes to go ahead. Okay, perfect. Everybody wants like A+ level. And also our clients' concern is mainly towards the risk of failing into greenwashing or investing in the wrong company for the wrong reasons. They really want to play the sustainability bet in a good way. The second concern is and I call that skeptical and deniers. You know, because this is a newborn model and must grow up and evolve. In that process, for sure, corporations will make mistakes and fails. Our concern is that will be used to question the whole model. We have seen that the request for perfection in the new model is sometimes unreachable. That you have to be perfect, and that is not going to happen. We have to walk a long walk. Both sides, even the deniers and the people that are in the impact investment world, will have to learn to live and respect each other during that transition, because if not, we can look like we are the new bosses, and all that we say is the perfect thing. And no, we have to live together, and it's going to take, I think, 5, 10, 15 years, I don't know. And the third point, the third concern is the short-term objective pressure. In the financial markets, it used to work with 3 months objectives. Every 3 months, you have to report how the company is going. And that doesn't work here. If you want to impact investment perspective, if you want to work in change the world, that won't happen from today to tomorrow. So this time we really need to long-term vision in order to reach our goals, and that's what we have, the 2030 agenda. But that are the three worries that we have.
No, I very much echo that, especially your point about the being willing to accept not having complete perfection. There's an expression, I think Rebecca Solnit came out with this expression, the cynicism of perfection, and using that as an excuse for doing nothing. And I think it's very important to avoid that, especially.
Perfect. I'm going to write that expression because I like it.
Well, I can't claim the credit, sadly. But,
Yeah, very great expression. Well, and coming back to the issue about greenwashing that Iker mentioned as a big concern on the institutional investors. But I would like to ask you, what kind of methodologies or frameworks are you using now while working with institutional investors, for the products that you offer, for the case of a responsAbility, but also for the case of the services or the investment that you can recommend at Portocolom for your clients? Then maybe you can tell us a little bit about that.
Perfect. For the illiquid assets, we are the Global Impact Investment Network members and follows the IRIS Plus methodology in conjunction with the Impact Management Project. For liquid assets, we have developed our own methodology based on SDGs and Sustainability Accounting Standards Board and track how companies are doing efforts to become more sustainable businesses. We are believers of the best effort of the companies to make a transition toward a more sustainable mode. That's how we work in our methodology.
Okay, great. Maybe Paul, could you tell us a little bit?
Sure. Well, I think it's a tribute to the fine work done by the GIN and the Impact Management Project that my answer to this is going to sound a lot like Iker's, in the sense that, as I said, we're only on the private side, but the framework and the approach that we have towards this is partly guided on, so effectively for every one of our overall approach is, of course, in line with the operating principles for impact management, which is a set of principles set up by the IFC, and which is the investing arm of the World Bank, and to which we are a founding signatory. And that's got about, I think, somewhere in the region of 120 odd signatories now. Most of the leading impact investors, I would say. But when you get down into the details, what that means is that effectively every single one of our products, we have a clear impact narrative, which is step one of the IFC principles, and under which we attribute 3 impact strategies to every single one of our products. So we say for every single one of our products, there are 3 different ways primarily that we expect them to have an impact. And then what we will do is we will generate a score that is based on those 3 strategies, and that's our means of selection. And after that, we will monitor, this and via a series of metrics, and then we examine where we are at the end of it. Now, as Iker was saying, the GIN, their IRIS Plus system, and the Impact Management Project, they play quite an important role. First of all, in terms of guiding our selection of strategies. I mean, we don't follow it 100%, but it's a very useful guiding platform. And then also, as part of that, the GIN has defined various impact metrics using their IRIS catalog, which basically says, okay, if you're going to ask for an average loan size, this is how you calculate it, which is good for our investee companies because they don't then have about 20 different, they don't get requests for average loan size calculated about 20 different ways. And then the Impact Management Project's 5 dimensions. This is a kind of mini theory of change whereby you say, what is the problem? Who is affected by it? What is your contribution to it, etc. That is kind of the structure, if you will, for our impact scoring model. So we use this kind of, effectively what we're doing then is we're calculating an impact score for each one of these 3 impact strategies. And that's used by us to calculate how impactful each investment is, as well as what our contribution would be to the impact of the organization if we were to invest. So this, in a nutshell, is the approach that we take.
Okay, thank you. Thank you for sharing that with us. Well, I would like to know, coming to the end of this panel, why do you think that it's important to mobilize capital from institutional investors towards a sustainable and impact investing or impact investing strategies?
Okay, because there is no plan B, because it is mandatory that we all mobilize capital toward innovation, research, new business models. The way we have been doing business is where we are right now, and we know that it's not working, so we have to change that. We have to learn new ways to work, to learn, to travel. It's the only path to restore errors from the past. Give decent job to young people, contribute to healthier planet, therefore reduce inequalities. As Ban Ki-moon said at the SDG launch, our world is facing a lot of challenges, but let's not forget there are also a lot of opportunities. And the path towards sustainability is full of opportunities, and for all those who embrace sustainability correctly. So I think because there is no other choice.
Great. Paul, would you like to go?
I mean, I completely agree with Iker. There is no choice. And let's be clear about this. Climate change is something that's going to affect all of us. We can't pretend, this is something that's going to only happen in a faraway corner of the world. All of us are going to feel this one way or the other. You only have to look at, where, the pictures of where the glaciers were in Switzerland, say 50 years ago or 70 years ago versus now to know that this is a problem that is going to be on our doorstep. Likewise, when you see coverage in the media of the fact that, a larger number of people were displaced by climate change than by conflict this year, that's, again, it's a very clear example of what is coming up on our shores right now, what is happening to us directly. And so there's really no way of getting around this. The good news is that it's also a tremendous opportunity as well. There are products out there. There are innovative, interesting products. There are products with good, solid track records. There are, there are a lot of possibilities out there. And frankly speaking, there's a good possibilities from a returns perspective as well. We have plenty of investees where, frankly speaking, we've seen some extraordinary growth because fundamentally they are providing a service which is otherwise, not really present. The 1.7 billion people who don't have access to finance around the world, the hundreds of millions of people in Africa who still don't have access to electricity. Now, if you're able to tap into that unmet demand, you're not only having an impact, you're also tapping into one of the few remaining untapped markets in the world. So it's in everyone's interest, and above all, it's in investors' interest to try and find a way to access that.
And even as we said before, even if you want and if you don't, the regulation is going to impose that you have to change that because there are not other options. We know that there are not other options, but from our perspective, we have to give time to the people to change. We don't have to impose that immediately. It's a transition. Everybody needs time, but it's going to change, and it's a fact.
Yeah, I think that it's very important to keep this in mind, that the path towards a sustainable future includes or needs the finance sector, and this path is full of challenges, but it's also full of opportunities. With this, I want to finish this panel. First of all, I want to give thanks to Paul and to Iker because they have shared with us a lot of their experience and such an insightful conversation. Well, thank you so much to both.
Thank you very much, Paul. Thank you very much, Monica. A pleasure to be here with you, as I said, first of all.
Thank you, Iker, and thank you, Monica. It's a pleasure to be here, likewise.
Thank you to both.
Bye.
Take care, bye-bye.